Hello traders, James Stanley with StoneX and FOREX.com. It was a riveting week in the FX market, and there's a lot going on. If you look at the DXY chart, it might not jump out, but the underpinnings of the DXY basket have very much been on the move, and I'm going to be out for the next couple of months. I'm going on paternity leave, so won't talk to you guys for a little while, and I wanted to be sure to cover this in this video where I look at a couple of scenarios that I'm looking at around the USD and, well, related components. First, need to look at a risk disclaimer. I'm going to leave this up for 15 seconds up front, 30 seconds on the back, and it will be in the description field of this video. Please review that, pause the video, take more time to review that if you so need. I will be on the other side, and we'll start looking at charts. All right, here we go. So first and foremost, some color on the comment that you might not have noticed this in the DXY basket. It's really a messy outlay in DXY if you look at this on a weekly. I covered this in the webinar on Tuesday, but I'm considering this as a bad tick from the Monday open, the Sunday open. If you look at this on like a 1 minute chart, much of that move was relegated to the first minute of the after the open, which it feels exogenous. It feels like it's a bad tick to me. And this is something that I've seen replicated across multiple price feeds, including the ICE feed, the Intercontinental Exchange feed. So my assumption is that was a bad tick. That said, there was a pretty dramatic drop on Thursday. And this, I think, highlights something that still matters a lot. That is the importance of the Japanese yen carry trade, not just to FX markets, but to global markets as a whole. And it's a pressure point. It's something that I think is going to continue to be a big deal. And let's just go ahead and look at it. So the 160 level in dollar yen has been increasingly being tested. We saw this tested back here in March temporarily, the pullback of which buyers jumped on near immediately. That 158 area, that's the area of support around 158, held a couple of different bounces. And then it was into FOMC that we tested above 160 again. And then bulls were, again, I talked about this in the Tuesday webinar. It was like bulls were going to test the resolve of the finance ministry to see if they would actually intervene. And then they did intervene on Thursday morning. It was a violent move. It was more than 400 pips, peak to trough. But you look at what's happened after, and so far, it's on a relative basis, it's been somewhat weak. And it's like I've been saying in webinars, I think the line in the sand that the BOJ ultimately wants to defend is higher. I think that they're in a very unenviable position with higher oil prices, burning their finite FX reserves, that they don't necessarily want to defend this antiquated line in the sand that has already begun to budge. I think if anything, they're going to draw that line in the sand deeper to like a 161.95 level, or maybe even a 165 level, before they'll actually be able to stall the move. And, you know, opening the realm of possibilities, maybe even something like a 170. But you got to trade for A and B before you can get to D, E, F, and G. For now, this has basically been a pullback. And for next week and going into deeper into Q2, this is still my preferred long USD setup. And it's largely because of the rate differentials between the pair. And this is something that I think matters quite a bit here. The intervention that we saw this week resembles what we saw back in September of 2022. Back then, it was the 145 level that the finance ministry wanted to defend. And you can see that stalled the move for a little while. They even intervened here. And it got us a pullback to 140. But bulls jumped in, got right back on the bid. Then they drove up to 150. And eventually all the way up to 150, 195. Here, the BOJ again intervened. And again, drove a pretty minor pullback. This time, 145 comes in as support. Buyers jump in. They buy it at 145. What ultimately compelled this reversal was not the BOJ. It was US CPI. US CPI came out below expected. Markets started to look at the fact that inflation in the US is softening, and maybe the US is getting closer to rate cuts, or, well, fewer rate hikes, shall I say. And so the shifting dynamics and the fundamental backdrop is ultimately what helped this crowded trade to get a little less crowded. And then it was as we took out these supports, you notice the move hastened. And so it's almost like these trailing stops were getting hit and more pullback was starting to show. All the way until we got the 50% fib in mid-January, and then buyers simply jumped right back in. So a really clear example of where not only did an intervention fail, but even an intervention that was seemingly successful did not work, quote unquote, work in and of itself. It was the US CPI data in November that ultimately compelled that reversal. Similar episode in 2024. Now that 151.95 price became a big spot. 2023, it stalled the move. Another episode of below expected US CPI. In this case, now there was the building hope for possible rate cuts. That got a 23.6% pullback. But again, fundamentals remained decisively tilted to the long side of the pair. Now, what does that mean? It happens in a couple of different ways. One, first and foremost, if you're a retail trader, you're probably aware of swap or rollover, and that is a direct component of incentivization. If you're long the high yielder and short the low yielder, you can earn rollover just for being on the long side of the pair, or on the side of the pair favoring the higher yielder, in the case USD against JPY. And conversely, if you're short dollar yen when US rates are significantly higher than Japanese rates, well, you're in a position where you might have to pay. So setting in this short position could be a cost on a daily or near daily basis, while holding a long position could be a credit on a near daily basis. There's literally a built-in incentivization system via swap or rollover that pushes traders into the side of the pair with a high yielder. On the other side of that, there's an actual usage here. If rates in Japan are near zero and rates in the US are at 5%, if you, as a hedge fund or an institution, can go to a Japanese bank and get a loan when central bank rates are at 0%, maybe you get a loan at 1% or 2%. You get cheap capital. And then you can go and invest that in the United States or elsewhere where central bank rates are 5% or higher. And your aim is just to try to pocket the spread. Now, the problem in that situation is that now you are essentially long a weak currency. So if the Japanese yen weakens significantly against the US dollars that you're investing in, well, then you can watch all of that spread whittle away and then some. So the only rational thing to do in that position is to hedge your currency risk, which you do by selling in the marketplace and buying US dollars or euros or some other currency. That further pushes on the long side of the pair. So it's like, as long as the fundamental backdrop is showing that rate differential, that unevenness between rates, it's almost like that's the direction of the tide. That's the direction of the ocean. Good luck fighting that. And that's precisely what these interventions have been trying to do. Now, in April of 2024, we got above expected US CPI. The hope for rate cuts that year was dimming. And you could see where we broke above 151.95 aggressively. We went right up to 160. At that point, the BOJ had to step in to try to prevent a meltdown in the currency. Similarly, it was one single week of weakness. Price found support at 151.95, the same high in 2022 and 2023, and then buyers simply loaded the boat again. A couple months later, we're back above 160. What made this one, quote unquote, work, again, it wasn't anything directly related to the Bank of Japan. The BOJ did intervene here, but this was on the morning of a US CPI print that came out below expected, and this was finally when US markets had the confidence that the Federal Reserve was about to start cutting rates. The prospect of narrowing rate differentials. So if you are holding that hedge from your Japanese bank loan that you had invested in the US and you wanted to hedge your currency risk, and you see dollar yen beginning to fall, you look at rate differentials between the two economies now expected to narrow with the US getting ready to cut rates. Do you really want to hold on to that hedge? On top of that, we just hit 160, a multi-decade high. Becomes an opportune area to cut bait on that trade. And that's precisely what happened in here. The pair goes spiraling out of control. But the thing is, the trades that were being funded by that carry trade, those banks, those hedge funds that were going to Japan to get cheap Japanese loans, well, the trades that were being funded by those loans also started to come out. That's where the rubber hits the road here. We started to see a global tech sell-off on the back of that move. July 11th, the NASDAQ 100 hit an important high at the time. The same morning that we had that intervention and that lower than expected US CPI. Lower than expected US CPI, markets are finally going to get those rate cuts they've been looking for, and the NASDAQ sold off. This is why. Because the aggressive, overbought trades that were being fueled by cheap Japanese rates also started to come off as the carry trade began to unwind. Right here, the morning of August 5th is an important one. This is when we had the third highest ever spike in the VIX index, rivaled only by the financial collapse and COVID. And it didn't take long for major media headlines to point the finger at the Bank of Japan as the reason behind the sell-off. So the whole reason for bringing this up is if we do see the pair spiral out of control, like if you look at this from the weekly chart, this to me looks like it's set up for a breakout. It looks similar to an ascending triangle, increasing frequency of tests at 160, series of higher lows. If we do see this even go below 150, there's the prospect of collateral damage in there. So for policymakers, I think ideally they want to see some element of balance. They want to see some element of stability. They'd prefer to see dollar yen range bound and holding in here. The big question is whether or not market participants are going to allow it. For now, until something changes, I still like the long side of the pair, especially given that we've had a recent pullback on the back of an intervention effort. I don't think that the BOJ is going to find it so simple to continually intervene to defend 160. Oil prices have something to say with it, as do finite FX reserves. So for now, my long USD component is going to remain at dollar yen. Even if we do get a deeper pullback, like let's say that the BOJ wanted to shock markets a little bit more, there's supports here, 154.45 to 155, and then 151.95 to 152.50. It's once we get below 150 that I think the math needs to start changing a bit. But even in that scenario, I don't want to look for dollar weakness against the yen, because those intervention moves, they're tough to catch. Instead, I like dollar weakness against, well, first the euro. This is a setup I've been following really closely in webinars of late. We had a pretty clean setup this week when we had dollar strength on Wednesday after the FOMC as dollar yen was cresting above 160. A perfect touch at 116.55, which is the very top of the resistance turn support zone that I've been tracking in the pair. This was the high back here earlier in March. Notice that held as resistance for about a month until we had the breakout in April. So far, that is support at prior resistance. Along the way, we had a falling wedge formation that had built. And as that USD weakness was coming in, like I said, and dollar yen is too violent for me to try to catch it. The only strategy I have for something like that is hope and praying and guesswork. In dollar yen, it was much more structural. Initial rally on the back of that USD weakness found resistance right at 117.19. The pullback of which holds higher low support. Then we go right up to 117.42. Then a pullback to support at prior resistance. Then another rally up to a fresh higher high. Now, notably, this was not above the April high, which I'm going to talk about in a moment. But for USD weakness, this is still the market that I like a bit better than dollar yen. 117.19 becomes an obvious spot. It's already very nearby, but 116.99 is the next spot down. That's my S2, and my S3 is right in here around 116.67. Even a hold there would justify a higher low from the swing on Wednesday night. The other market that I'm still following for USD weakness is over here in the British pound. And I followed this one really closely throughout the month of April because as we came into April, sterling was actually looking weaker than the euro. On March 31st, we set this fresh low, whereas in euro dollar, it was a higher low. But there's another one of those falling wedge formations. Falling wedge is a bullish reversal formation, helped along by a point of support coming in to stall sellers, even though sellers are still active at resistance. But it's as we get that break, as we get that change of pace, that's when the door opens for bullish reversal potential, which is exactly what played out here in April and then again on a shorter term basis later in the month. But While euro dollar remains below its April high, notice the sterling has already burst out above its own. Similarly, we're in pullback right now as we go into the weekend, but this is a nearby spot of support potential 135.68. And this is the bigger zone. It's 134.84 to 135. It has been messy of late. But notice how we held right here, just slightly above that prior swing low. So that becomes a point of invalidation. If we get below that swing at 134.58, that's when it's going to start to look like this whole thing has failed. And in that case, my anticipation is that dollar yen would be making an approach back towards that 160 handle. So that's why I want to work with dollar strength there. But for dollar weakness, I think this one still has a case against both dollar yen and euro dollar. But euro dollar, pound dollar, my two USD weakness setups as we go into next week. Dollar yen, my USD strength setup. And that's what I'm looking at as we go deeper into Q2. Now, like I said, I'm going to be out for the next couple of months, but I wanted to address these topics in a big picture fashion because I think these intervention efforts are just really very interesting, and there's a lot going on that, maybe a lot of people don't care about the dynamics of it, but I do. So I wanted to share that with you before I went away for a little while. But as always, thank you for your time, and I wish you, ladies and gentlemen, happy trading, and we'll see you very soon.